Now that the Federal Reserve has really shown signs of strong commitment, like they're going to be as hawkish as you can be. And hawkish is just another fancy word to say that we were going to continue to do whatever it takes in order to bring inflation down. Because the target they have in mind is 2 to 2.5%. So we have a long way to go for this inflation to be brought down. All right. So now that they pretty much being as committed as possible, as committed as they can be in fighting inflation, there are 3 money moves that I believe everybody should do. And from my perspective, this is what I'm going to share in this video. All right. Now, the first thing is, remember, one of the key takeaways of Jerome Powell's speech on Friday, which pretty much broke the market, was there's going to be some pain ahead, both for the consumers and for businesses as we fight inflation. Now, the thing is, it's going to take a long time for inflation to go back down from 8 to 2% because they're going to look at the data month to month, week to week, just to see how the labor market is doing, how business inventories are doing, how supply chain issues are going, how the price of commodities are doing, in order to decide when to stop. Because they pretty much said on Friday, we will do whatever it takes. All right. So it means, as we mentioned in another video, that people are going to get hurt. All right. But you can prevent yourself, your household, and your money from being hurt or from getting impacted if you do these 3 moves. Number 1 is because they're going to be potentially additional layoffs, because as interest rates increase, it means that company will refrain from investing because money is going to definitely be costly. And maybe because people are now more selective into what they decide to buy and not to buy because prices are still high, it may also push them or force them to shrink margins. So for some companies, it may mean we need to also start saving costs, and that means we need to let some people go. So if you are in a sector or in a company where you feel as if things are not as, you're not as comfortable in the next 12 months that you are going to still be at that place employed with this company, then it's now time for you to start bumping up your emergency fund. Because although there are plenty of jobs out there, you don't want to just take chances of not getting employed and with prices really, really high, be thrown out of your apartment, maybe your lease, maybe of your car payment, etc., etc. All right. So this is the first move, making sure that you have some sort of backup plan coming when it comes to the money you will need in case or while you are going from one job to another. All right. So I'm not really concerned about people finding jobs because there are really tons of jobs available out there, both from a full remote, hybrid, in person, from sector to sector, etc., etc. All right. So that's a good thing if you kind of think about it. But I'm thinking about starting to, I was already saving a lot of money just to get ready in case, this recession thing provides opportunities. But now that the Fed has pretty much shown signs of strong commitment, it's just natural to think that, hey, I need to bump up my emergency fund. Now, if you already have, a 6 maybe to 12 months emergency fund, then I think it doesn't hurt for you to have that additional extra cash, maybe sitting in a high savings account, like ALI is now close to 2% APY in terms of, high savings yields. But so that if an opportunity comes up, maybe somebody's selling out at a discount, maybe somebody's selling a car at a discount, maybe somebody's selling a business at a discount, maybe somebody needs a partner, you have the money to take that opportunity so that when things get better, maybe in a year, maybe in half a year, 18 months, 1.5 years, you will be in a better place so that your future self will thank you for the move you did today. All right. So the second move I'm thinking is try really to get out of what they consider bad debt. All right. Now, if you're in a car loan, if you're in a consumer credit loan, if you're have high credit car debt sitting, just find a way to start maybe making a little bit more than just the minimum payment if you can. All right. If you cannot, find a way to maybe consolidate everything so that you can have that everything bundled in order to have, that interest kind of average down for you to have maybe a less monthly payment when you add up everything. Because as interest rates continue to increase, it means that your debt is going to cost you a lot more to service as you maintain it. So if you're in a position to pay off maybe half, maybe 30%, maybe just 25%, or maybe just bump up that monthly payment, then it's definitely a good thing, because you are giving yourself options, and it will feel like you are giving yourself a raise, which is definitely something needed as prices are remaining very, very high. All right. Now, the third move is really for people that are in a position where, like myself, I don't really need to bump up my emergency fund, because I have almost 12 months of emergency fund set up now, and I have I have a couple of sources of income that are kind of giving me that comfort that if I lose my job, for example, or maybe if one of those sources, is now struggling or is completely drying out, I don't have to get out there in gazelle intensity. All right. And these are people that have, extra savings or extra cash sitting on the sideline they can use to invest in order to get advantage in the shift coming in the stock market. All right. Because if you look at the market sell off on Friday, literally the only sector who was not affected with the Red Sea was the energy sector, because we have two main things coming up. The first thing is, the number one reason why prices have gone down on the oil and gas energy sector is because of what President Biden did when it comes to, releasing the, sovereign petroleum reserves. Like, this is there is an amount of oil that we need to keep as reserves as a state. And he pretty much dried it out. So it is as low as it ever been in the last 37 years. So what needs to happen is he needs to replenish those reserves, and ultimately it will push prices up, because it means there will going to be less supply. Now, the other thing is the organization of countries producing oil, the OPEC plus, has now decided that we might reduce the production or the supply of oil, because we see a discontinuity. We see a discrepancy between the price of oil that we see in the market and the reality of the terrain, the reality of the structure of our current market, which is there is not much supply. And whenever you have a market where not much supply but a bunch of demand, it means that product, your service, is going to go up. All right. So as the market is shifting and people are kind of repositioning the money, I think there's going to be a shift from the tech sector, potentially crypto, but not as much, as interest rates are supposedly to continue to increase, into this energy, maybe the cyclicals, and definitely energy is going to be very interesting, because even with prices at 90s when it comes to the price of barrel, a lot of companies, especially the small caps in energy, are still trading as if oil was at $60, $65, because people are thinking about recession coming. But this shift is going to definitely, have another bull run in this specific sector. And that's why it's going to be a good thing if you have the money to invest, to put it into these companies. I am personally invested into some of these companies for the last 2-3 years. I swing trade them, I day trade them, I invested in them also, not only for my money to grow, but also for passive income, because they are increasing dividend rates. So these are all good reasons why you should look at this sector. All right. Now, nobody has a crystal ball here, so I'm not kind of supposedly, allegedly implying that it's going to go as well. But this is just my thought based on my experience and what I see in the market happening. So yeah, those three moves, you make them, and I can guarantee you, whether we're going to a recession or not, whether the Fed is done with fighting inflation or not, until it happens, you wouldn't have to be worried, because you can sleep at night knowing that you have money at the bank in case things go south.